All right, let's finish up this chapter. So let's talk about residual income. The concept of residual income is how much money you're making beyond the amount of money that you want to be making. I know that sounds silly, but you expect to have a certain amount of income that you're making. You're certainly not in business to not make money, so you're expecting a certain amount of money that you're going to earn on the assets, right? So we've been talking about ROI. The idea here is that I have a certain amount that I expect to have as a return on my invested assets. Anything beyond that is gravy, if you will. All right, it's called residual income, and it's basically extra money. So the idea here, just a little bit of a visual of it, is you have income from operations minus, like how money, this is how much money we made. How much did we say we wanted to make? All right, and if that number is lower than what we actually made, then we've got some money left over, and that's our residual income. What did we make beyond what we wanted to make? Okay, so kind of like extra. So the idea here, looking at this rate of return concept, is we decided, let's say we're the company Data Link, and we decide that we need to have a 10% rate of return on our assets, meaning our assets need to basically produce at least 10% as an amount of income from those assets. So back to that northern, central, southern division here. We've got $70,000 worth of income the northern division made, right? Well, their assets, they had 350,000 assets, and we expect our divisions to at least use them, have a return on the investment of 10%. So that means we expected northern division to have at least a $35,000 income. And so the money that's left over, we actually made 70. We expected that we at least wanted to make a minimum of 35, so our residual income's 35. All right, central division, your income from operations 84,000. You expected to have a 10% return on the $700,000 in assets that you have. This is the assets that we looked at a few slides ago. So we had a 10%, we expected at least to earn 10% on those assets, meaning our residual income, because we made 84, we expected at least 70, so the extra income we made was 14,000. And you can do the same thing here with the southern division. All right, so the idea is that, well, as it says here, the major advantage of residual income as a performance measure is it considers both the minimum acceptable rate of return investment assets and the income from operations for each division. So not only are we looking at percentages, we're also looking at the dollar values as well. All right, so just to talk about this for a minute, is there another measurement tool that management uses, and it's called the Balanced Scorecard. What the Balanced Scorecard is it's not just numbers, all right? Everything we've looked at so far to determine how well we're performing has been based and calculated on pure numbers and data that we have available. Well, let's look at something other than a financial measure in order to determine how well our business is doing. And the Balanced Scorecard is a tool in which you would use that. All right, as it says, the Balanced Scorecard, the idea is that a company is not just about the dollars. It has performance measures built into it for customer service, innovation learning, internal processes, and let's look at the slide they're telling us about. So there we go. All right, so it's not just financial performance, which is really something that we as accountants tend to be focused on. They're saying you have to be balanced in all four of these areas in order to run a business well. So with that, just some examples. Innovation and learning, to fill in that, might be how many new products do we have? How many new patents do we have? How many should we be training our people? What is our employee turnover? Right, so the idea is that you're looking at all of these non-financial performance measures in order to determine whether or not you're balanced in this innovation and learning category. You want your employee turnover number to be low. You might say we only have, a 5% employee turnover number. And as long as you meet that performance measurement, you're doing fine. Right? The internal processes, how much waste and scrap do we have? How many defects do we have? Are we utilizing our labor, or are people standing around on the line because the jobs, maybe there are too many defects? The idea is that you would have percentages associated with all of these. You'd say, we only expect to have 1% of defects. and you would actually you would track that number, and you would see if you had 5% of defects, well then clearly you failed this part of the balanced scorecard, and you need to look at why you have more defects than you would expect to, because all of these things would slow you down. Waste, scrap, underutilized labor, they would slow down your business. Customer service is probably one of the easier ones to get your head around. Actually, one that I had to deal with personally in my last job prior to teaching. But with customer service, you would say, well, how many repeat customers do we have? What is our customer satisfaction rating? Maybe we want to have a customer satisfaction rating of 90%, that they're entirely satisfied. Well, if that's the case, then we would have some sort of survey to determine that, and we would monitor that information. All right. The last job that I had prior to teaching, actually, customer satisfaction was incredibly important to us, and it was something. We had these ridiculous measurements that were all based on the balanced scorecard. Some things like we had to call a client back within an hour. If we didn't call a client back within an hour, that was basically a fail towards our customer satisfaction rating. Kind of interesting and difficult to do when you go to lunch sometimes. Okay. And financial, we've certainly discussed all of these financial measures. All right. So the last thing I want to talk about is transfer pricing. What happens is, we've talked about like decentralized operations and whatnot. Let's say we've got 3 different businesses all under one company, and those 3 different businesses do 3 different things. Well, the idea is, how does business A sell something to business B? Right? Now, the question is, what price do we charge each other? So if we're all working for the same company, what would Division A charge to Division B for Division A's products? Well, there's 3 different approaches you can look at here. You could use the market price approach. So that would mean Division A, whatever they're selling to Division B, they would just sell it to Division B for whatever the regular market price is. So Division A is making out just fine, but Division B, quite honestly, could go somewhere else and make more and do better somewhere else. Maybe the market price that maybe Division A is selling for something for more than what they could get somewhere else. All right, they could use a different company entirely and get a better cost on the product. So, but that is one approach, is to use the market rates, because why should you make company A suffer and not make the same amount of money, not make the same amount of profit on a product that they're selling, if they're just because they're selling it to a sister company. All right, so that's one way of doing it. You can sell things to each other for a market price. Another thing could be, and I would imagine this is the most common, would be a negotiated price. So maybe you wouldn't, if you're company A, you wouldn't charge company B the market price, but you would charge them a little something. You would charge them a certain amount of money, and that would be in some sort of a negotiated amount. And the third approach would be purely based on cost. So that would mean company A would sell it to company B for basically the cost it took them to make the product itself. So they would be making no money on it. So if it cost them $10 to make the product, they would sell it to company B for $10. Then this hurts company A because they're not making the profit that they want to, but it's benefiting company B. So these are things you have to consider when you're looking at the company as a whole. You're looking at all of these 2 things, all of the businesses together. The cost approach might be better for company B, but worse for company A. So you have to think about these things when you're looking at the results of how a company is doing, or how a division is doing. Okay, so there you go. You've got a visual of what I was talking about there. All right, and these are all things that I just talked about. All right, and that's it for this chapter. I hope I have been helpful to you. Have a great day.